Hello again, everybody. I'm John Kosar from Asbury Research, and this is the Asbury approach to investing video for July 2022. You can subscribe to these videos below. This is actually a very small subset of a much larger and much more detailed monthly report, one of many that we produce for our paid subscribers. The purpose of these free monthly videos is to introduce professional and private investors to our unique data-driven approach and quantitative models. All Asbury Research reports and models answer two primary questions. Number one, should I be invested? And how much should I be invested? And number two, which parts of the market should I be invested in? Let's begin. This first slide just is a little bit about me. This is actually my 42nd year in the business. I got started and kind of grew up on the floor of the Chicago Mercantile Exchange in the 1980s and 1990s. I spent 17 years down there, and that basically was my education into the business. Not really from the academic side, but more from the practical side. Going to work every day and being around people that were trading for a living and just kind of learning the markets from the inside out. By the way, this PDF, I'm going to kind of breeze through some of the descriptive stuff and get to the market-based stuff, which I'm sure is what you want to see most. However, if you'd like to get a copy of this PDF, I'll be showing some contact info at the very end. All you need to do is call us, or you could contact us through our website, asburyresearch.com, and we will send you a copy of this PDF if you want to look into it a little further. What we do, again, basically is two steps. Should I be invested? And then what should I be invested in? So we point out risk on and risk off. And for us, risk on is you're either holding what currently is in your portfolio or you're looking for opportunities to add. Risk off means you're playing defense. Your offense is off the field and your defense is now in charge, and you're tightening your protective stops, checking what you own to see what's performing and what's not, and really starting to think of trying to protect capital rather than make money in the market. And then we look at which parts of the financial markets are performing best and which are performing worst. So when we are in a risk-on mode, we're in places where you are more likely to get some relative outperformance versus the benchmark S&P 500. If the market's going down, as it's been for the first half of the year, relative performance is still very important, especially if you're a money manager and you can't go cash. You can't go to 100% cash. Most money managers that I know of can maybe go 20% cash, but otherwise their clients expect them to be in the market. So we show you where to be in those situations where if the market is down 20, as it is now, maybe your investments are down 15 or 13. In that case, it's a real big winner for you and your clients. How we do it? Early in my career, I did a lot of forecasting. That's how you got on CNBC and how you get quoted in the Wall Street Journal. This second half of my career, so to speak, this past 20 years, has been more and more focused on following the money. Oftentimes, the market moves before the story comes out. Everybody knows why the market moved after the bell rings and the market's closed. The more difficult part is to get on these trends early before everyone else is talking about them. And we do that by following the money. We have 5 different models that do that. Our CPM model, or correction protection model, we built this about 10 years ago to answer the request of a lot of money managers that said, can you just make me an indicator that's going to be less risky than the stock market and gives me basic signals? Should I be risk on, adding risk, or should I be risk off? We'll take a closer look at all of these, including the CPM, a few slides in. The Asbury 6 model is our daily indicator for the stock market. It tells us what the under the hood condition of the market is. We built this because the way the market trades now is much different. Most of the daily volume comes from algorithmic trading, computers trading back and forth with each other, and as a result, you're getting a lot of the market's up 100 today, it's down 50 tomorrow, it's up 30 the next day. A lot of these moves are very confusing. I think they force people to make bad decisions in terms of getting kind of dragged into the market or getting spooked out of the market at exactly the wrong time. So the Asbury 6 looks at the market underneath the hood and shows you what the internal condition is. It gives us a more of an accurate day-to-day representation of what the market's doing and thus how we should respond in terms of buying or selling. Our SEAF model is an asset flow based sector rotation model, it's able to show us where the money's going in the sector space very early in the game, and it shows us where the money's coming from. It allows us to be a lot more agile with sector rotation, staying on the best sectors, staying away from the worst ones while still keeping our risk very low. Our CARP models, CARP stands for Cross Asset Relative Performance. That looks at 8 different relative performance comparisons for equities and 3 for fixed income. And finally, our US versus the world market looks at the US S&P 500 versus 24 foreign markets that basically encompass the globe. And it shows us which of those are outperforming and underperforming in 3 different time frames. So let's get to the current research. Our first chart is simply the S&P 500, and we've drawn in a lot of support and resistance levels for you. So what you see here is basically since the beginning of June, we've been bumping up against an important band of support in the S&P 500 from 37.23 all the way down to 36.88, and it's held. Here's the June 17th low down here. This is the bottom so far for the 2022 downtrend. And then we also show you where the resistance is. The trend is down on a back of the envelope type of basis because the S&P is below the 200-day moving average, which most people look at as the major trend, and it's below the 50, which is blue on our charts. The 200's orange, the 50's blue. Most people look at the 50 as the minor trend. What we call tactical primary resistance in the market currently is at 39.41 to 39.46. We are testing that right now. You probably saw my eyes look up towards our screens. We're testing the resistance now, 39.41 to 39.46. We're breaking it by just a little bit. This is where the major downtrend should resume if this rally that we've had from the June lows is just a bounce in an uncompleted bear market. So a very big deal. If we could start to trade steadily through the 39, it's called 39.50 area, that would suggest to us that a more meaningful bottom is in place at those June lows. Here's our CPM now. CPM, again, was designed for wealth preservation, try to reduce the volatility in the market. But what we found is that if we build some of that beta back into the CPM model by using a leveraged ETF, you could still retain a lot of the safety features that CPM has, but it could really turn the model from a defensive one to an offensive one. Here's what I'm talking about. This is the model, CPM model from 2011 through the second quarter of this year, which was just this past June. And what we see here is the model on average since then trails the S&P by 2.2% a year. So you'd say, what good is that? Why not just be in the S&P? Because CPM takes a lot of the risk out. So up here is the performance. Down here are some of the quantitative metrics that we look at to find if a model is desirable or not. So you can see the beta on CPM is 0.42 versus an assumed 1% beta for the S&P 500, since that's the benchmark. So according to beta, less than half is risky. Then if we look over here at maximum drawdown during this entire period since 2011 in CPM has been 15% versus 34% here for the S&P 500. So keeping up with the index pretty closely with less than half the risk according to these two metrics. There are other metrics to look at here. Again, if you want the PDF, just ask us. Now we took CPM here during the same period, 2011 through the second quarter of this year, and we tried to build some of that risk back in by using a leveraged ETF. In this case, we used the 2 times leveraged ETF, or the SSO, and you can see now we're outperforming the S&P on average by 6% a year, where we were underperforming by 2 and change. Now if we go down here, look at the beta, it's made it more risky. It's taking the beta up to 0.84, but it's still underneath the 1% assumed beta for the S&P 500. And then if you look at the max drawdown, that's gone up. That's gone up to 30%, 29.5%, but we're still underneath that 34% for the S&P. So now we've built some risk back in, still a touch riskier, or still a touch less risky than the S&P 500 itself, but now we've got a lot more outperformance. So this model is currently risk off, and it has been since July the 13th. A little bit more about CPM here that we've pretty much gone through. Now let's look at the Asbury 6, which is our other tactical in-house model. And that's the one with the 6 metrics that look to get the real kind of lie detector test version of what the condition of the market is, rather than up 100 today and down 100 tomorrow. So our Asbury 6 had been negative when we finished this. As of July the 12th, it had been negative. It just turned to positive just this morning. We're actually doing this on July the 20th, about mid-morning in Chicago. So this model has actually turned positive as of the close yesterday. And here's all these metrics. Or actually, this is another metric that I wanted to show you that I think is critically important right now, and one that we're watching. We put a lot of emphasis on asset flows taking place in key ETFs. One of those is the QQQ ETF Invesco, QQQ, which tracks the NASDAQ 100 or the NDX. So you see the NDX up top here since the beginning of the year, and you can see these assets. 21 days or 1 business month is our tactical time period. So when we're making a tactical decision, like should we get back into the market from being risk off, we use a 21-day type of lens. For strategic, which we view as being 3 months or 1 quarter out, or farther out than that, we use a 63-day moving average because it represents 1 business quarter. Takeaway here is you can see the total net assets in the QQQs are starting to rise up above the 21-day moving average. That tells us that there is some risk appetite starting to come back into the marketplace, and maybe some leadership. What the market's been lacking all the way down this year, there's been no leadership except for energy. And energy is not a traditional leader for the stock market. Small cap is, technology is, semiconductors is. None of those were leading. This is an indication to me that we might be starting to get some leadership from technology, and that's a good sign for the market. These are a couple of sentiment metrics which I would view as being environmental rather than tactical. Environmental meaning they don't tell you what to do today. They tell you what the condition of the market is historically. So there's 2 here. This is a futures trader sentiment. It's a modified version of Jake Bernstein's DSI, or Daily Sentiment Index. And you can see here that these, I'd call them near to intermediate term oriented futures traders, are as negative on the market, as least bullish on the market as they've been going back a couple of 2-3 years or so, and starting to come out of that least bullish extreme. You can see these green verticals show 4 other times that they came out of similar extremes were all important bottoms for the market. March 2020, June 2019, and so on. This chart on the right is the investors' intelligence data, of which Asbury Research is one of the is one of the constituents, one of the contributing firms for this index. And you can see that these, first of all, these are stock market newsletter writers, advisory services like Asbury Research is, market advisors. They have a longer time period typically. I would call them more intermediate to long term. Look what's happening here. They are hovering at least bullish extremes going all the way back to 2010. 12 years ago. They are coming out of these extremes that again have highlighted bottoms in March 2020, Jan 2019, March of 2016, and so on. This doesn't tell us to buy the market today necessarily. That's what our Asbury 6 is for. That's what our CPM is for. But this does tell us that the next tactical bottom that comes out of this strategic indicator has a better likelihood of becoming a strategic bottom. That's why we're paying so much attention here, because we've avoided most of the downtrend this first half of the year because our tactical models, our CPM and our Asbury 6 had told us risk off, and we moved out of the market. This is telling us that the next time the tactical CPM and A6 tell us to get back in the market, this could be more of a strategic type of an entry that we can keep for for 1, 2, or 3 quarters going forward. And ideally, that's what you want to do. You want to avoid the downdrafts, take that money you saved during the first half and be able to reapply it when the market's 20% underneath where it was at the very beginning of the year. That's nirvana for us. That's what we strive to do. Here's another one. This is options premiums. This is IBD, options premium data, that shows that these data are as extreme as they have been going back to 2007. And March 2020, these 2018, October 2008, they were at this extreme. You could see on the chart they were all really important bottoms. I'd call them longer term bottoms for the market. That's where we are now. Again, this isn't a buy signal to tactically go in and buy today, but this tells us the next tactical bottom that we get coming out of these extremes and options data could turn out to be a strategic bottom, and that's what we want. We want to try to buy near the strategic lows. These past 2 slides tell us that it looks like we might be there now. Here's our CART model. It's cross asset. So we look at 8 different cross asset relationships. This is updated on the weekends once a week, and you can see right now a couple of trends I'm paying attention to. The NASDAQ right now is starting to outperform, the NASDAQ indicating technology is starting to outperform the S&P 500, indicating the broad market. You could see it's outperforming it from the beginning of July. Follow my mouse pointer all the way across. So we've got a new emerging trend where tech is outperforming the broad market. That shows risk appetite. I see that as being bullish. The one right underneath it, you see growth starting to outperform value all the way across the board from basically the middle of last month. The middle of June is when it started. We had been overweight value for the first half of the year, and we did quite well. I think we outperformed the S&P by 8 or 10% during that period. This trend appears to be changing. If it is, it indicates risk appetite, and it supports what we're seeing in those last couple of investor sentiment tools. There are 3 fixed income relative performance comparisons as well, which is a government bond versus corporates, high yield versus corporates, and then short or long-term bonds. We're not going to cover that today, but that is a part of the CART model. So here's our low volatility, which you can see. Let's go back once. You can see low volatility is still in effect. We have been overweight low volatility. It's outperformed the S&P 500 SPY, the ETF, by 17% since November of last year. So during this period of the past 2 quarters where the market's been weak, this is one of the overweights that we've had, is low volatility, outperformed by 17%. So that means if the S&P was down 20% during that period, this particular ETF was down 3%. That's very good in a bear market. But you can see this trend is starting to run out of gas. It's bumping up against its 63-day moving average here, which is, again, our strategic time period. If it rolls over from here, that would give way to high beta, and it would be seen by us as another indication of risk appetite, which is good for the market. Here's our US versus the world model. This looks at 24 different global equity markets versus the US in 3 different time frames: trading, tactical, and strategic. And right now you can see only 2 of these are outperforming the S&P 500, Hong Kong and China, which obviously related to each other, different parts of China. 4 weeks ago, half of these foreign markets were outperforming the US. There's only 2 now. I see that as an indication that global investors may believe US stocks are at a value area, again, which makes the next tactical signal so much more important. Here's China and Hong Kong. Since our model, US versus the world model, pointed these out as overweights. Here on May 18th, China, MCHI, has outperformed SPY by 12%, and EWH, which is a Hong Kong ETF, has outperformed the SPY by 10% since May the 10th. Here's our market sectors, SEAF model, Sector ETF Asset Flows model. This might be my favorite model because it follows asset flows rather than relative performance, which means we can see the money moving in before the price of these ETFs actually start to move in a meaningful way that one could see on the chart. So you can see the latest data, and this data is through July the 11th. We actually have an update to this available to subscribers. It's in our research center, asburyresearch.com. But this is about a week ago, and this showed a continuation of the 310 March 10 trend of inflows in healthcare and a resumption of the 623 trend of inflows into technology. Technology is good. That means there's appetite for risk. They're going into technology. We saw it on the CART model, and we also saw it 6-7 slides back, total asset flows going into the QQQ. It's also showing a continuation of 3-3 trend of outflows from financials. So it's had us moving out of financials since the beginning of March, and financials have done poorly since then. We have avoided financials because our model showed us that's where the money is coming from to go into currently right now healthcare and technology. So here's XLV. This is healthcare. Our model, our SEAF model, went overweight on March the 10th. You can see it's outperformed the S&P 500 by 10% since then. Here's XLE. Our model actually, and this is where most of our profitability came from in the first 2 quarters of the year. Our SEAF model went overweight XLE on Jan 10, and it moved out of XLE on June the 24th because the model showed us the money was leaving energy for the first time in months and going elsewhere. So we actually got out of there in this period, in on Jan 10, out on June 24th, and captured 40% of relative outperformance versus the S&P 500 during this period. If you weren't in energy over the past couple of months, it was really hard for you to make any money. This is where it was at in terms of where to be, and our model got us in very early. Nobody was talking about energy on January the 10th, but we saw the money moving there according to our model, and we moved there right along with it. Here's a little bit of statistics on the SEAF model. These are the past 8 quarters through this past quarter here that ended in June. And you can see that SEAF has outperformed the S&P 500. 7 of those 8 quarters, the only one it didn't outperform was the last quarter of 2021, and it only underperformed by 1.9%. You can see since January of this year, it's outperformed the S&P by 13.1%. Since this entire 2-year period, over the past 2 years, it's outperformed the S&P by 37.5%. Here's the quantitative part of that. Okay, what's the risk? It performs well. What are some of the risk numbers look like? Well, the beta on SEAF is 0.78 here versus 1 for the S&P 500. So the beta, the risk according to beta is lower. Look at our annualized total return. 29.2% for SEAF versus 14.7% for the S&P. Look at our max drawdown during this past 2-year period. Only 14.6% for SEAF compared to 23.6% for the S&P. And finally, look at the up capture versus down capture. Up capture, 117% during this 2-year period, which means basically 17% more up capture than the S&P. It caught 17% more of the period where the S&P was going up. And the down capture, only 46% versus basically 100% for the S&P 500, which means when the market was going down, it was in the market at that time less than half the time. So this is a good model. It keeps you in the market, but it keeps you in the places where the money is going. Finally, here's a chart of SEAF over those past 2 years. I'm a chart person. I can see it better if I see it on the chart. SEAF is in green. S&P 500 is in blue. This is going back 2 years or 8 quarters, and you can see SEAF. All the wiggles basically look the same if you look at them closely, because the sectors that SEAF is picking are subsets of the S&P. However, you can see the outperformance here, much greater here by SEAF. So there you have it, a little bit of an education on our models and our approach, and current analysis for you too, kind of what we're looking at, where we've been this year, and where we think the market's going. So again, if you would like further information about us, if you'd like a copy of the PDF, or feel free to contact us, or if you like to be notified on these videos, we're doing them once a month. They're free to educate you on what we're doing here at Asbury. Feel free to subscribe via YouTube. Thanks for attending this one. Have a good rest of July, and we'll see you next month.